Welcome back, everybody, to the Informed Home Buyer Podcast. And today is all about a recent headline about medical debt not showing on your credit report anymore. So we're going to go through this. Who is this going to affect? Who is this not going to affect? Who's it going to help? Who's it not going to help? Was it really hurting you much before? Is this going to have much of an effect on the industry? We're going to unpack all of the truth and all of the myths around these headlines so you can figure out if this actually will be something that helps you get a new home loan in 2025. As always, I'm your host, Rich Curtis, and I have with me lender extraordinaire Dave Miller. Welcome back, Dave.
Hey, Rich. Thanks for having me.
All right. Now you might be able to hear I caught the flu. I have kids. If you have kids, you know they are the most efficient disease transferring devices ever invented. So if my throat's a little scratchy on today's pod, I apologize. But the headlines here are that as of the March reporting cycle, so once the credit reporting bureaus run the March report, then from that point forward, medical debt will no longer show on your report. And the media is making it sound like this is going to be a huge boon. I've heard stats like 22,000 new mortgages could be initiated this year because of this. It could bump people's credit scores up to 20 points. And they're forgiving $49 billion, not forgiving, pardon me, they're removing $49 billion in past medical debts from the credit reports. So let's start off with what's actually happening. Dave and I were just talking offline. It's not actually taking all medical debt off of the credit reports. So it is going to remove all paid medical debts. If your debts are paid in full, they will be removed from the credit report. It's going to remove all medical debts under 1 year old. So if you just got a recent diagnosis for cancer, just went through 6 months of chemo, and you're applying for a home loan, within a year of that debt hitting your report, it won't show. And if it's under $500, it won't show. However, if it is medical debt that is greater than $500 and greater than 1 year old, it's still going to be right there where it used to be. So we're going to jump right into, is that really going to affect us much, Dave?
Yeah, well, I think the one qualifier there too, Rich, that we point out is when we're talking about medical debt, we're talking primarily about medical collections, because if you have a provider and you have medical debt and you're making your payments on time, it's not typical that they're going to report to the bureau. So from a lender's perspective, I wouldn't know if you had medical debt that was being paid on time directly to your provider. So we want to make sure that we make that clear. So that doesn't mean, so we also don't want people to stop paying your medical debt directly to your provider, thinking it's going to go to collections and just get wiped out and go away. That's not the case.
Yeah, that's an important point. None of this is debt forgiveness. There's no debt forgiveness component to this legislation. This is just what type of debt will show on your credit report and what won't. There's no forgiveness component. And so don't stop paying any of your bills.
But and I think long and short of it, for folks that this will affect some people. I think what it's mostly going to impact is not going to be your ability to qualify for a loan from a debt to income ratio perspective, but your credit score. So if you're on that borderline of credit score, and those borderlines are typically in 20-point increments. And so, there's a big difference between 660 and 680, 680 and 700, the type of loan you're going to get, whether you get a Fannie Mae DU approval, because if some of this debt's not show up on your credit report, the likelihood you may have been in a situation where you didn't get an electronic approval, but now you will. So there are some folks that it'll help, but every scenario is going to be a little bit unique. So that's where we need to have a discussion and understand what you currently have and what you will have in the short term once this takes place.
And what you as the lender sees and what you don't see. I think that was a really important distinction between a medical debt being paid to your provider versus in collections. I was telling Dave just before the pod, my wife's delivery of our first child was kind of a dangerous and traumatic delivery. We ended up with a $30,000 bill out of pocket for that. And I'm leaving the hospital with a sick wife and a brand new baby. Don't know what I'm doing. They sit me down at the desk and they say, it's going to be 30 grand. What do you want to do? And I just needed to get the baby home. So they said, don't worry about it. We'll put it on account for you. Make payments, call us back, and you can pay it off when you're ready. Just get the baby home. That was super kind. We did end up calling them back and taking care of the debt. But for some period of time, we had medical debt sitting there. And certainly had I gone to get a mortgage, I might've been worried, well, that's a new $30,000 debt affecting my debt to income ratio. But all of that type of medical debt that you're actively paying on, that's sitting with a provider in an in-house account software somewhere, is not reported to credit reporting agencies. It's only you never paid them, you refused to pay them, they gave up, and they sold that debt off to a credit collections agency. It went to collections, and boom. Or they have, in the case of the hospital, an in-house collections department for default, and that department then referred it to the credit agencies for reporting. If you're paying your medical debt and it is with your provider, it's not going to affect this. So now Dave just made another important distinction between debt to income ratio and credits. So, and credit score. And now this isn't going to affect anybody from a debt to income ratio, not because of the new legislation, but because it never actually really did. Most of the loans didn't really take that into account. So can you sort of walk us through how, the loan agencies dealt with medical debt that was reported previously from a debt to income perspective?
That was reported for FHA, Fannie Mae was really, for the most part, not considered as a hitting you from your debt to income ratio perspective. So, and there has been some debt that has not been required to be paid off. So some medical collections, or some collections on your credit report, or most collections, need to be paid off before you can close on a loan. Fannie Mae just, their requirement, you have to pay this collection. Well, medical collections were not required to be paid. And often some medical collections will show a payment. Sometimes you've negotiated a payment and there'll be a payment associated with that. That's not hitting you on your debt to income ratio. So again, really talking about for qualifying for the mortgage, that's still going to show, certain parameters that'll still show up on your credit report. But it wouldn't preclude you from purchasing a home. But if it's not going to be visible anymore, like we said, it may impact your credit score, that put you in a more favorable position for both interest rate and type of loan that you qualify for.
Yeah. So debt to income ratio, we've got other podcasts where we go through all this stuff in a really granular way. But basically, if you make $4,000 a month and you had a $2,000 a month medical payment that you were making, if they were counting that against you, your debt to income ratio would already be 50% without taking into account any of your other bills. And our maximum ratios are in the 48 to 50% range that your housing, your mortgage can be of your overall. So right there, if you make $4,000 a month and have a $2,000 a month medical bill, you're pretty much not getting a mortgage if they counted it against you. That's how debt to income ratio works. And they never really counted that against you for the medical debt. So that wasn't a problem before. So it's not a problem now. So this new legislation isn't really helping in that regard. What Dave's talking about is it is helping in regards to credit score. So having that medical debt payment and having that debt outstanding has an effect on your overall picture as a borrower. You have this amount of debt out there. Based on that, they have this black box calculation at the credit reporting agencies that they do that spits out a risk assessment of you and then attaches your score to you. And it has had an effect on that in the past. And what the news media is saying is it's been up to a 20-point effect potentially on some people. We don't see a lot of high medical debt borrowers coming through. So I don't think I have the experience, Dave, to say, yeah, I've seen it affect someone's score 20 points. Have you really had that, hit your desk?
Yeah, no, and not recently. I think, and there was a time where medical debt was counted, right, and had to be paid. So, all those changes have taken place. And so it's not, because it's not precluding people from buying homes anymore. So sometimes we don't pay as close attention to it as we used to years ago. And so, it's not a pervasive issue, but there are people in unique scenarios. And again, I think we talked about this. We're not encouraging either. Do not pay your medical provider thinking it'll go to collection. It's just not going to show up anyway. It's not a win-win like that, right? Like there's still going to be some affect your credit score if you do that. So if it's not meeting certain profiles, I think what you read, Rich, is for the first up to a year, it won't report. Is that?
Yeah. That's what we were saying at the top of the show. So medical debt that is within the last year, less than 1 year old, won't show at all, even if it's in collections. Medical debts $500 or below that are in collections won't show. But if the debt is more than 1 year old and greater than $500, it will still show even after the March reporting of this year.
Yeah, and I can guarantee you what's going to happen is you're going to decide you want to buy a home and you're not worried about that. And while we are getting ready to you find a home you love and everything looks great, and then that medical collection is going to pop up if you weren't paying it.
Yeah,
that's just inevitable. That's the way it goes from a timing perspective. So if you are,
yeah,
just keep paying the provider so it doesn't go to collections, especially if you're buying a home. I don't know what your other motivation would be to letting it go to collections. I can't speak to that, but even though you wouldn't have to necessarily pay the collection amount, but it would drop your credit score if it did report on your credit report.
Yeah, and you want to be, if you are in collections, you want to be working with these people and trying to get those accounts in good standing. We had a mutual client several years ago. They were about to buy a very expensive home in a very expensive Bay Area town, and they were selling their primary residence. And in the state of California, when you sell your primary residence, once you sign the contract to sell it, there's kind of no backing out for the seller. The buyer has to mess up and blow a timeline twice for you to really back out. However, when you buy, of course, you can back out for any reason. So I told him, you got to run your credit, make sure you can buy the house you want to replace this house with before I list your home and get you a buyer. It's going to sell quick. He ignored me, one of my best friends. So it's always your friends that ignore your advice. He ignored me because he had recently bought an expensive luxury car, run his credit, and it was fine. And it wasn't the luxury car purchase that screwed up his credit. It was a 10-year-old, like from college, $50 collection from T-Mobile that got sold off all the way down to like the Joey the knee breaker chucklehead level of collections. And that guy didn't know how to properly report the debt to the credit reporting agencies. He reported it against the wife in a way that made her credit score unreportable. She wasn't zero. She was unreportable. And it took like 14 lenders and weeks and weeks and weeks to solve that problem. We finally did. His buyers wouldn't let him out. He was going to sell his house. He had 2 huge dogs, was going to be homeless, basically. And we managed to solve it, but it was very stressful. It was very hard. Had her score been a 0 or a 5, we probably could have got a loan. The husband was fine on his own, but it being unreportable made it a big deal. So once you get in the hands of collections, this can have a big effect. You never know what these people are going to do and how they're going to do it and how that's going to affect you. So certainly, kids, the moral of the story is pay your bills and stay out of collections. But if you are a person who's sitting there who has some medical debt that you couldn't pay because life happens and it went to collections, and now you're coming good on it, you're making those payments, you want to buy a house, and you've been checking your credit score and you're just too low. You're say below that 680 threshold that would get you sort of access to the best rates. And you've been trying to figure this whole thing out. You're the person that might win with this new legislation. You're the person that, that might get this worked out. You've paid off the debt. It's good. Now it'll clear off the credit report. Maybe you get that 20-point bump and you go from a 660 to a 680. And now you can access the best rates, which is really crucial in an environment like this with rates in the 6 and 7%. You can't afford to be taking any hits because of problems on your credit. So that's really the person who should be paying attention to this. Someone who has medical debt that went to collections, has satisfied the debt and paid it off, but hasn't seen the credit recovery after that, hasn't seen their credit score bump up and has been waiting to qualify for better loan rates. That is the small segment of the market that's going to comprise those potentially, which I think it's a specious number, but potentially 22,000 new mortgages that this will generate.
Yeah, and I think the good news here too, Rich, is we're talking the end of March. So we're talking, what's that, 75 days from now, roughly, based on the timing of this podcast. But usually when this stuff comes out, sometimes we got to wait till the beginning of the following year, or at least there's light at the end of the tunnel in the short term here. So and that's one of those things too, where you're close enough and you're thinking about buying a house now. It may, talk to me or your local lender if you're not buying in our area, and we make that determination if we should just run your credit report now, knowing that this is going to happen, and have a pretty good idea. Is it worth waiting for?
Yeah, and this is a good question too. And you may not be able to answer this because this is new, and so these things shake out in different ways, and we don't always know as practitioners in the industry. As new regulations come down the pike, there's a wait and see period where we have to see exactly how this is treated and what the processes are going to be for accessing the benefit of this. But one thing that comes to my mind is, okay, it's April. I'm that buyer. I had a high amount of medical debt. I satisfied the debt. My credit score has still been low. lower than I need it to be for a loan or for the type of loan I want to get. Now I want to access that potential 20-point bump. How do I do it? I pull my credit score and it still looks the same, right? That's where contacting a lender comes in. And Dave, I wonder, is that a scenario where we don't know, we have to see, and you might just pull the trigger on a rapid rescore and see if it resets?
Yeah, I would say I think if you were to start looking for a home today and we pulled your credit and you found something and you qualify today, we would make that determination, because there's so many moving parts here. You may say, well, for example, my credit's 680 today, but if I wait till the end of March, it's going to be 700. I'm going to qualify for better interest rates. Well, guess what? If you wait and there's no guarantee, rates might be a quarter point higher just based on the market.
Right.
So, waiting for something that's going to give you a nominal bump, I don't necessarily think is the best idea. If you're ready now, we have a conversation. To your point, Rich, maybe it takes us, 45, 60, not, we get closer to the end of March and we say, okay, well, maybe, with a credit bump here, we haven't gone into contract. Let's rerun this at the end of March and see what happens. I don't see a downside to doing that, after March passes. So we get into April.
Do you think, based on your experience, that this will sort of automatically report and the scores will automatically adjust? Or do you think you'll have to sort of pull the trigger on? So for those listening, if you haven't watched some of the other podcasts, a rapid rescore is just a tool that Dave has as a lender to say, we just did a few things to adjust your credit score. Maybe you paid off a line of credit, you paid off a credit card or whatever, or you handled an old collection, and we need a new score now for your loan quickly. He can pay and do this rapid rescore thing. It's a tool that he has.
Yes.
Again, watch some of the other pods. Do you think that's something you'll have to employ in this case, or do you think it'll all sort of wash out naturally?
I think it'll wash out, because a rapid rescore isn't necessarily going to help in this scenario.
Okay.
Typically, a rapid rescore is usually when you've paid down some debt, but just doing a rescore showing that it should fall off automatically, that a rescore is not going to. The only time we'd want to do a rescore in this scenario is if it still reports there for some reason and it was an error. It was reported an error and we can document that debt didn't belong to you. So we now provide the evidence that debt didn't belong to you, and then we do a rapid rescore.
Gotcha.
So that would be that scenario.
There could be some cases where some of this debt is sticky and we know it qualifies to have been erased from the score and we didn't see it, and that might not be a rescore. Maybe that's just some calls to the credit agencies to talk to them, or maybe use a rescore in that case to see if we can bump it off.
Yeah, I think that's another case of one of these scenarios, Rich, where we're just going to have to kind of get to that point and navigate and see how this really shakes out.
Yeah. Now, from the 30,000 foot view, people always worry when there's new regulation like this. How's this going to affect the market? Well, okay, there's going to be 22,000 new loans potentially generated. Does that mean as a seller, I'm going to have a whole boatload of new buyers in the buyer pool for my listing? As a buyer, does that mean I'm going to have a whole bunch of new buyers now to compete with, and we're going to see more multiple offers and craziness like 2021? And I'll get your take, Dave, but my take is I don't see this having a significant industry-wide impact. 22,000 new loans is a drop in the bucket.
Yeah, if those 22,000 were in your town and my town, it would make a difference. But we're talking nationwide. Like, it's really, I don't anticipate. I don't really anticipate much of impact at all.
Yeah, and 22,000 buyers spread across all of the markets of the United States is going to have no impact whatsoever from a having buyers for a listing perspective or having buyers to compete with if you're purchasing perspective, in my opinion.
Yeah, I agree.
So to wrap this thing up, folks, the headlines are making this seem like a really big boon for homeowners. And I wish it was. I'm looking for any kind of big boon for homeowners I can get. I'm looking for anything that makes homeownership more affordable. That's good for America. That's good for you, our buyers. That's good for our sellers. That's good for Dave and I as practitioners in the industry. Anything that makes home buying more affordable is good overall. And there's a few of you that have unfortunately suffered from medical debt that went to collections. And for that select few, this is a great thing. I'm glad it's happening. I hope it helps you. I hope some of you are watching this podcast, so it can help you, and you can reach out to, again, us if you're in our market or your trusted lender in your market and say, hey, now this is cleared. I can buy a house now. There's a small number of you that it's going to do that for, and I'm really, really grateful that it is. But industry-wide, as a big sweeping thing that's going to affect a lot of people. No, I think this is really a niche case thing. It'll help a few of you. I hope for those of you, this podcast helps you figure out how this is going to help you and what to do next. And for the rest of you, we're going to have to stay on the hunt for things to make homeownership more affordable for you. So as always, you've made it quite a long time listening to Dave and I prattle on about the news here and the real estate industry. If you've made it this far, you are deeply committed to your own financial education, and we thank you, or you're just a glutton for punishment. Either way, thanks for making this end with us. Thanks for watching. We'll see you on the next one. I'm Rich Curtis.
I'm Dave Miller. Thank you.
All right, guys. Have a great day.